4 American banks are holding $186 trillion in bets. That's not a typo. 186 trillion. If any one of those banks miscalculates and fails, your bank account freezes. Your credit cards stop working. Your paycheck doesn't clear. And there's nothing you can do about it because you're about to find out that your entire financial life is hostage to a market worth $600 trillion that almost nobody understands. Warren Buffett called it a weapon of mass destruction 20 years ago. He wasn't exaggerating. This weapon nearly detonated in 2008. It required $29 trillion in global bailouts to stop it. The response wasn't to disarm the weapon. It was to make it 10 times bigger. And right now, the triggers are being pulled. You need to understand what's about to happen because when this explodes, there won't be a bailout large enough to save it. Let me tell you what they don't want you to know. There's a reason you've never heard of derivatives, even though they're 6 times larger than the entire world economy. Because if regular people understood how the system actually works, there would be bank runs tomorrow. The whole financial system runs on confidence, on the belief that your money is safe, that banks are stable, that the government can step in if something goes wrong. That confidence is a lie, and derivatives are the proof. This isn't some abstract financial topic that doesn't affect you. This affects everything. Your retirement account, your mortgage, your savings, your job, all of it sits on top of a $600 trillion house of cards that's about to collapse. And I'm going to show you exactly why. Start with this fact. In 2008, the derivatives market was worth about $60 trillion. When it crashed, it took Lehman Brothers, Bear Stearns, AIG, and nearly every major bank in the world with it. The global economy required $29 trillion in bailouts, guarantees, and emergency lending to survive. $29 trillion to stop a $60 trillion problem. Today, that market is $600 trillion. 10 times bigger. Do the math. If the crash is proportional, it would require close to $300 trillion in bailouts. There isn't $300 trillion in the world. Global GDP is only $105 trillion. The entire wealth of every country, every company, every asset on Earth isn't enough. That means when this crashes, there is no Joe Yan. There's no government big enough, no central bank powerful enough, and no amount of money printing that can stop it without destroying the currency itself. But here's what makes it worse. You don't even know which banks are holding these bets. Let me tell you their names. JP Morgan Chase, Citibank, Bank of America, Goldman Sachs. These 4 institutions hold 90% of all derivatives in the United States. JP Morgan alone is carrying $54 trillion in exposure. $54 trillion against total capital of about $300 billion. That's 180 times leverage. If their bets move just 1% in the wrong direction, the entire capital base gets wiped out. At 2%, the bank owes money it doesn't have. And because these 4 banks all trade with each other, all lend to each other, and all depend on each other staying solvent, if one goes down, they all go down. It's not for separate institutions. It's one interconnected bomb with 4 fuses. Now let me explain what derivatives actually are, because once you understand this, you'll realize how insane the whole system is. A derivative is a bet on the price of something without actually owning that thing. It's like buying insurance on your neighbor's house. You don't own the house. You just collect money if it burns down. Except in the case of derivatives, you can buy insurance on 1,000 houses you don't own, collect if any of them burn, and you never have to prove you had any legitimate reason to buy the insurance in the first place. That's the derivatives market. It's a casino where you can place unlimited bets on anything. Stock prices, interest rates, currency movements, even the weather. And the bets are leveraged, meaning you only put down a tiny fraction of the money you're actually betting. JP Morgan might enter a $100 million bet but only put up $1 million in collateral. That's 100 to 1 leverage. If the bet goes bad, the bank loses 100 times what it risked. Multiply that by thousands of contracts and you have a system where small market moves create catastrophic losses. The real danger isn't the bets themselves, it's what happens when someone can't pay. In 2008, Lehman Brothers held $35 trillion in derivative contracts. When Lehman went bankrupt, every institution that had traded with Lehman faced sudden losses they hadn't expected. A European bank that thought it was protected against mortgage losses suddenly wasn't. A pension fund that thought it had locked in an interest rate couldn't collect the payment. And because every major bank had exposure to every other major bank through derivatives, Lehman's failure cascaded through the entire system in hours. That's when credit markets froze. Nobody would lend to anyone because nobody knew who was holding the next bad position. It took the Federal Reserve creating $4 trillion out of thin air and governments worldwide injecting another $25 trillion to unfreeze the system. Even then, it barely worked. But here's the part they didn't tell you. The 2008 bailouts didn't save the economy. They saved the banks. AIG, the insurance giant, received $180 billion in bailouts, but that money didn't stay at AIG. It was funneled directly to the banks that had bought insurance from AIG. Goldman Sachs got $12.9 billion, Bank of America got $12 billion, Merrill Lynch, Deutsche Bank, dozens of others all got billions. The taxpayers bailed out the gamblers, and the gamblers learned that no matter how reckless their bets, the government would rescue them. So what did they do? They made bigger bets. That 60 trillion market became 600 trillion. The weapon of mass destruction got 10 times larger. Now stop and think about what that means for you. Every dollar in your checking account, every dollar in your retirement fund, it's all in one of those 4 banks or invested in companies that depend on those banks. If JP Morgan fails because its derivative bets blow up, your money doesn't just lose value, it gets frozen. The FDIC insures deposits up to $250,000, but the FDIC has about $125 billion in its insurance fund. JP Morgan holds $3.7 trillion in deposits. If JP Morgan goes under, the FDIC couldn't cover even 5% of the losses. Your money vanishes. Not because you did anything wrong, because the bank made leveraged bets with money it didn't have on assets it didn't own, and the government can't print enough to make you whole without destroying the dollar. And here's what nobody is talking about. The triggers are already firing. Not in the future, right now. Let me show you 3 that are active today. First, interest rates. The Federal Reserve raised rates from near 0 to over 5% in less than 2 years. That's the fastest rate increase in 40 years. Every time rates move, derivatives tied to interest rates win or lose massive amounts. Over 500 trillion in derivatives are tied to interest rates. Even a 1% move creates trillions in gains for some institutions and trillions in losses for others. The losers are sitting on those losses right now, hidden on balance sheets under accounting rules that let them pretend everything is fine, but the losses are real. And when those institutions have to mark their positions to market, the capital disappears and the banks become insolvent. Second trigger, commercial real estate. Over $2 trillion in commercial mortgages need to be refinanced in the next 18 months. Office buildings, shopping malls, hotels, all financed when interest rates were 2%, now refinancing at 7 or 8%. The buildings can't generate enough rent to cover the new payments. Defaults are coming, and those defaults trigger derivatives called credit default swaps. Bets on whether those mortgages will fail. The institutions that sold protection, that bet the mortgages wouldn't default, will owe tens of billions they don't have. That's the egg scenario again, except this time, there's no Federal Reserve willing to print $180 billion to bail out the gamblers, because the third trigger makes bailouts impossible. Third trigger, sovereign debt. Japan owes 260% of its GDP. Italy is over 150%. The United States is at 120% and climbing. These governments are broke. They're already spending more on interest payments than on defense, education, or infrastructure. If they tried to borrow another 10 or 20 trillion to bail out derivatives losses, the bond markets would collapse. Nobody would buy the bonds. Interest rates would spike. Debt payments would consume the entire government budget. The choice becomes bail out the banks and destroy the currency through hyperinflation, or let the banks fail and face economic depression. There is no good option, and that's what makes this different from 2008. Back then, governments had borrowing capacity. They could take on debt to save the system. That capacity is gone. The governments are now as leveraged as the banks. So here's what happens when the derivatives market explodes. And it will explode. Not if, when. It starts with one institution that can't meet a margin call. Maybe it's a European bank. Maybe it's a regional American bank. Doesn't matter. That institution fails to pay what it owes on a derivative contract. The counterparty, the institution on the other side of the bet, suddenly faces a loss it wasn't expecting. That loss wipes out capital. That institution now can't pay its obligations to a third institution. The failure cascades. Within hours, multiple banks are facing losses that exceed their capital. Regulators step in, freeze trading, try to arrange bailouts. But the losses are too big. Tens of billions become hundreds of billions become trillions. The government announces emergency measures. The Federal Reserve creates lending facilities. None of it works because the scale is too large. You can't bail out losses that exceed half of global GDP. Within days, maybe hours, bank accounts freeze as institutions go into receivership. Credit cards stop working because the payment networks depend on banks that are now in. Paychecks don't clear because payroll systems can't process transactions through frozen banks. ATMs run out of cash as people panic and try to withdraw everything. Grocery stores stop accepting cards and checks, only cash. But most people don't have cash because everything was digital. Supply chains break because trucks can't buy fuel and warehouses can't pay workers. Unemployment spikes as companies can't make payroll. Within weeks, the modern economy grinds to a halt. Not because there's no food or no goods, because the financial system that moves money has collapsed. The government will try to restore order. They'll announce bank holidays. They'll promise that deposits are safe. They'll create new currencies or reopen banks under government control. But trust is gone. Once people see that their money can vanish overnight because of bets made by traders they've never met, at banks they didn't choose, the belief in the system evaporates. And without belief, fiat currency has no value. It's just paper backed by promises that have already been broken. What follows is a depression that makes the 1930s look mild. Because in the 30s, the economy was still largely physical. People grew food, made goods, traded locally. Today, everything is digital, interconnected, dependent on a financial system that just died. When that system goes down, there's no backup. There's no plan B, there's just chaos. Now here's the question you should be asking. Why isn't anyone stopping this? Why are regulators allowing for banks to hold $186 trillion in leveraged bets that could destroy the economy? The answer is simple. They're captured. The banks fund political campaigns. They employ regulators after they leave government. They lobby to weaken every rule designed to limit risk. After 2008, the Dodd-Frank Act was supposed to reform derivatives. It required some contracts to be cleared through central clearinghouses. It required more reporting, but it didn't limit the size of the market. It didn't ban the most dangerous types of derivatives. Within years, lobbying had weakened even those modest reforms. The banks argued that derivatives were essential for managing risk, that eliminating them would harm the economy. Regulators believed them, or pretended to, and the market kept growing. The other reason nobody stops it is because stopping it would trigger the crisis immediately. If regulators tried to force banks to unwind their derivative positions, the act of unwinding would create the losses everyone fears. Derivatives are like a Jenga tower. As long as nobody moves, it stays standing. The moment someone tries to remove a piece, the whole thing collapses. So regulators leave it alone and hope it doesn't fall on their watch. That's not risk management. That's Russian roulette with the global economy. In every quarter that passes, another round gets loaded into the chamber. So what do? If you're waiting for the government to warn you, you'll be too late. By the time officials admit there's a crisis, your money will already be frozen. The moves you can make are limited, but they matter. First, diversify where you keep money. Don't have everything in one bank, especially not one of the big four. Second, keep some cash at home. Not your life savings, but enough to cover a few weeks of expenses if ATMs stop working and cards don't process. Third, own assets that have value outside the financial system. Real estate, commodities, anything physical that people need, regardless of whether banks are functioning. Fourth, reduce debt. If the system crashes, debt becomes a weapon against you. Creditors won't forgive what you owe, but your ability to pay will vanish. Get out from under as much as you can now. And fifth, understand that this isn't fear-mongering. This is pattern recognition. A market that was $60 trillion destroyed the economy in 2008, despite the largest bailout in history. That market is now $600 trillion. The bailout capacity is gone. The triggers are firing right now. Commercial real estate defaults are happening. Interest rate volatility is spiking. Sovereign debt is unsustainable. Any one of these could ignite the cascade. All three are active simultaneously. The only question is timing. And based on the trajectory of commercial real estate refinancing, interest rate policy, and geopolitical instability, the window is 12 to 18 months, maybe less. Warren Buffett warned about financial weapons of mass destruction. He was ignored. The weapons got bigger. Now they're about to detonate. And when they do, the world on the other side will look nothing like the world we have now. That's not the future, that's the present, unfolding in real time. The only choice you have is whether you see it coming, or whether you're blindsided when it arrives. Subscribe and stay informed, because the next 12 months will determine whether you survive what's coming or get swept away with everyone else who didn't prepare.